Welcome to Speed Reads. Millionaire Mission. What's in it for me? A no-nonsense guide to financial planning. In a world where financial security seems increasingly elusive, many of us spend countless hours worrying about money rather than enjoying life's precious moments. How can we shift from a life of financial anxiety to one of abundance and control? Before we continue, please be sure to subscribe to our channel. Your support is greatly appreciated. What if financial success was a question of mindset, rather than earning a huge salary or having a trust fund? What if scrutinizing every financial decision could ultimately steer you towards your dream future? What does that future even look like, and how much wealth will you need to make it a reality? In this speed read, you'll discover a new way of viewing your finances, what long-term financial security means in practical terms, and how to create a plan to achieve it. By turning your income into a robust, productive asset that's working tirelessly on your behalf, you can master your finances and set yourself up for sustainable success. Financial success requires the right money mindset. Achieving personal, career, and financial success hinges on a transformative mindset. This journey is about much more than maintaining a positive outlook. It's about deliberately molding how you perceive and manage finances. Understanding the principle of deferred gratification is essential here. Imagine you decide to save $200 every month, investing it with an annual return of 9%. Starting in your early 20s, this strategy could grow your savings to $1 million by the time you reach your early 60s. This practice of prioritizing future wealth over immediate pleasures isn't just wise, it's a foundational strategy for building substantial financial security. If you didn't have a saving strategy in your younger years, you can still benefit from starting one now, so don't put it off any longer. It's just as crucial to reprogram your internal dialogue, particularly in the early stages of your career when your financial goals might seem daunting. Transforming this internal voice from one of doubt to one of possibility can dramatically shift your financial trajectory. Utilize every tool available, such as tax incentives and employer contributions to retirement plans, which can significantly enhance your savings and, consequently, your net worth. Balancing risk and reward is another key aspect. The comfort of low-risk options like savings accounts might seem appealing because your money remains safe. However, with interest rates typically lower than the inflation rate, this approach may erode your purchasing power over time. Conversely, the stock market offers higher potential returns, but comes with increased risk. So how do you choose the right strategy for you? Well, writing down your financial and life goals can provide clarity. When evaluating potential investments, consider both the possible gains and the risks involved. A well-thought-out risk can be beneficial if it's part of a strategic plan. This approach to risk management, measuring twice and cutting once, ensures that you're making calculated decisions. Finally, it's important to integrate continuous learning and adaptation into your financial strategy. As markets evolve and personal circumstances change, the ability to adapt and respond to new information is key. This might mean adjusting your investment portfolio, reevaluating your risk tolerance, or exploring new avenues for income. In summary, shaping a growth-oriented mindset, understanding financial principles deeply, and applying these insights consistently can dramatically enhance your trajectory, leading to significant personal and financial growth. Scarcity can help you achieve your financial goals. Financial independence isn't only a question of making money, it also requires smart management and strategic planning. One useful tool is the concept of forced scarcity. This means prioritizing saving over spending by deliberately limiting your available cash flow each month so you can meet your savings goals before your daily expenses detract from them. Forced scarcity streamlines the financial planning process. Instead of laboriously tracking every expense with a detailed monthly budget, this approach gives you the freedom to spend once your essential savings have been allocated. For example, say you were earning $5,000. At the start of each month, you would automatically transfer $2,000, or 40% of your paycheck, into various savings and investment accounts, such as a 401k, a Roth IRA, stocks, and bonds. With this essential savings goal secured, you are then free to use the remaining $3,000 for monthly expenses without needing to track every cent you spend. Of course, forced scarcity only makes sense if you've clearly defined your financial goals. That's why it's crucial to set aside time to outline both short and long-term objectives. These might include saving for retirement, funding education, eliminating debt, building emergency reserves, planning significant purchases like vacations, or even starting a business. During this stage, envision and record even your most ambitious goals, such as taking a dream vacation or retiring to an idyllic location. Once you've established your goals, prioritization is key. It's important to align your savings and spending according to the urgency and importance of each goal. Start by building a basic emergency fund that covers 3 to 6 months of expenses to provide financial stability in the face of unexpected setbacks. Next, focus on saving for retirement. The earlier you start, the better, as time significantly enhances the power of compound interest. Starting in your 20s or 30s can dramatically increase the growth of your savings, making financial independence more attainable. Conversely, delaying savings until later in life significantly reduces the potential growth of your retirement funds, making it challenging to build substantial savings. Finally, remember that it's always a good idea to prioritize retirement savings over educational funding for children or grandchildren. While educational expenses can be supplemented with loans, scholarships, or grants, retirement funding doesn't have similar fallback options. Ensuring that your retirement is fully funded should come before contributing to college or educational savings plans. Effective saving starts with a plan. Key financial goals like preparing for retirement require more than just the intent to save, they also demand a clear, actionable strategy. Understanding how much to save and tracking progress towards financial goals are central to this plan. To determine if you're saving enough for retirement, begin by multiplying your annual income by 25. This approach assumes you'll need 25 times your annual income to maintain your standard of living in retirement, considering a 4% annual withdrawal rate. For example, if you earn $50,000 annually, you should aim to save $1.25 million for retirement. This method is particularly useful for those more than 15 years away from retirement and provides a clear target for what needs to be saved annually, quarterly, or monthly. Alternatively, if you're closer to retirement, say, within 15 years, it's more practical to calculate based on estimated annual living expenses instead. To see how much you need to save, multiply your expected annual expenses by 25. For instance, if you expect to live on $30,000 a year in retirement, you would target savings of $750,000. This calculation should also account for any expected income from pensions or Social Security, which can reduce the total savings you'll need. Once you have a retirement savings target, the next step is to convert this figure into a periodic savings plan. There are numerous online tools and calculators that can help determine how much you'll need to save regularly. These tools often allow for adjustments based on different growth rates to reflect personal circumstances and market conditions. It's also wise to plan for variability in investment returns. The stock market is unpredictable, and returns can fluctuate widely over time. Using a conservative estimated growth rate, such as 6%, is a good starting point. However, it's beneficial to explore scenarios where returns might be higher or lower. This helps stress test your financial plan against potential market downturns and allows you to make adjustments to ensure your savings plan remains robust. In addition to these calculations and tools, setting and monitoring periodic savings goals is crucial. Whether these are set monthly, quarterly, or annually, regularly reviewing your savings progress allows you to stay on track and fine-tune when necessary. This ongoing evaluation mitigates risks and refines your strategy, ensuring you're well prepared for the future. Savvy investors tune out market noise. Navigating the world of investing requires a strategic approach backed by logic and patience, rather than following fleeting market trends. While seemingly straightforward, the fundamental principle of buying low and selling high challenges even the savviest investors, particularly when peer influence and market panic come into play. To successfully buy low, You must understand the intrinsic value of an investment and seize opportunities when prices fall below this level. Market downturns, often characterized by widespread panic and sell-offs, present such opportunities. The objective is to purchase assets at a significantly reduced price with the expectation that their value will rebound, offering substantial returns in the future. Conversely, selling high involves identifying when an asset's price has increased significantly and the market is at a peak, characterized by high buying enthusiasm. This is the optimal moment to sell and secure profits. The proceeds can then be safeguarded in more stable investments or reinvested in undervalued assets, so you can replicate your previous successes. Be prepared to make mistakes. Instead of succumbing to frustration or fear after a loss, use these experiences as learning opportunities. Reflecting on these can provide valuable lessons, such as the importance of thorough research and understanding your financial limits before committing to investments. Consider diversifying your investment strategy to include lower-risk options like index funds, which can provide less lucrative but steadier returns. Mitigating the influence of emotion on investment decisions can be challenging. To stay grounded, keep a written record of your past investment outcomes and future intentions. This practice supports a more disciplined investment approach, reducing the likelihood of impulsive decisions driven by market noise. Consulting with financial professionals can add another layer of analysis, ensuring that your decisions are well considered and are aligned with your financial goals. Ultimately, the goal of investing is to fund the lifestyle you aspire to lead. Making prudent, well-planned investment choices can accelerate financial independence, potentially leading to earlier retirement or providing the financial freedom to make big decisions like changing careers. Successful investing hinges on the ability to remain rational, adhere to a well-crafted financial plan, and resist popular, yet unproven, investment trends. Sound planning takes best and worst-case scenarios into account. Financial planning doesn't occur in a vacuum. Life, with all its changeability, tends to get in the way. There will inevitably be unforeseen problems, like illnesses. Even desirable changes, such as starting a business, relocating, or switching careers, involve significant risks. Financial success requires getting ahead of these risks. In other words, it hinges on meticulous planning and preparation. So, let's wrap things up by looking at some simple yet effective strategies that will help prepare you for major life transitions. The first step is to establish a robust liquidity plan. The importance of having a solid financial cushion can't be overstated, especially when venturing into the unknown. Typically, it's advisable to have 3 to 6 months of cash reserves. However, for those taking on higher-than-average risks, expanding this safety net to 36 months of reserves can provide critical support, transforming potentially short-term challenges into long-term successes. Next, you'll want to develop 3 distinct 5-year plans, using spreadsheets to map out potential outcomes. The first 5-year plan is a realistic projection. This should be a grounded forecast of expected outcomes, serving both as a benchmark for progress and as a realistic guide through the journey. Then there's your worst-case scenario. It's crucial to plan for potential setbacks. Identifying what could go wrong will help you craft strategies to avoid these pitfalls and course-correct when necessary. Finally, make a plan for your best-case scenario. This optimistic projection acts as a motivator, setting a stretch goal that, while challenging, frames what success could look like beyond baseline expectations. In addition to these plans, seeking guidance from a mentor can be invaluable. Connecting with someone who has already navigated a similar path allows you to learn from their experiences and avoid common pitfalls. Mentors can offer wisdom that only comes from first-hand successes and failures. If you can't find a mentor, joining a peer group can also provide valuable support. By combining these strategic approaches, you'll equip yourself with a well-rounded toolkit for navigating life's major transitions, increasing the likelihood of achieving both long-term security and financial success in new ventures. Final summary. In this Summary to Millionaire Mission by Preston, you've learned that achieving financial success hinges on a transformative mindset that emphasizes strategic planning and investment. Early saving and wise investing that utilizes compound interest are crucial for long-term wealth accumulation. In addition to this, adopting forced scarcity will help you prioritize essential savings over immediate spending, supporting you in meeting your financial goals. By balancing risk and reward in investments and adapting to changing markets, you'll maintain and grow your financial independence. Okay, that's it for this summary. We hope you enjoyed it. If you can, please take the time to leave us a rating. We always appreciate your feedback. See you in the next one.